The price is lying and the spread is telling the truth, and that's why the COMEX had to gap the way it just did. Not because the world suddenly discovered silver overnight, because the paper market ran into a problem it can T-solve with commentary. Real metal doesn't care about narrative, it cares about availability, timing, and who's willing to deliver. And when you see talk of Dubai silver printing near 96, while COMEX rips 5% in the dark, the instinct is to treat it like clickbait. Don't. Treat it like a stress test that just failed. Because if you understand what actually changed you, I'll stop reacting to the candle and start watching the mechanics that force the next move. 3 levels that matter. The one calendar window nobody respects until it hits them and the hidden inventory detail that flips the whole story. And that's where the real pressure starts. First, let's clean up the Dubai at 96 thing, because half the internet hears that and assumes it means spot is literally 96, and the Trumbotsas, the real price, is being hidden in an alley. That's not how it works. Dubai is a physical market with its own quirks. Retail premiums, wholesale deals, fabrication costs, local demand taxes and fees, and the simple fact that someone in front of a counter wants metal now, not a theoretical price on a screen. So when a headline says Dubai silver at $96, what it usually means is that in that physical ecosystem, the all-in price the buyer experiences after premiums and the reality of sourcing can look wildly higher than the reference spot you were used to. It's not one clean number. It's a signal, a loud one. It tells you premiums are stretched, availability is tight in certain forms, and price discovery is leaking out of the pure paper benchmark into the messy world where metal actually changes hands. But that's not the part that matters. The part that matters is why a paper market that normally shrugs at physical premiums suddenly moved like it got spooked. Because paper only reacts like that when the arbitrage that YES supposed to keep everything glued together stops working smoothly. In calm times, if physical is too high relative to futures, the smart money sells the expensive side and buys the cheap side. Metal flows, spreads compress, the dislocation fades, and everyone goes back to pretending the screen is reality. In stress times, the arbitrage becomes a trap. Financing gets weird. Borrow costs jump, delivery timing matters, logistics become a bottleneck. And the real killer, the people who can actually move size, refiners, fabricators, banks, big traders, start prioritizing survival over hero trades. They stop providing liquidity because it's their job, and they start protecting balance sheets. That's when the screen has to gap to find sellers. And silver is notorious for gapping because it is thin enough to move and volatile enough to scare people out of the way. Now zoom out for 2 seconds and look at the broader context, because this is not a one-night story. Over the last month, silver has not been creeping, it's been sprinting. You'd have seen the metal rip from the low 70s earlier in January to around the triple-digit neighborhood by late month, printing levels that force every leverage participant to recalculate their life choices. And when something is up 40+% in a month, it doesn't matter whether you're a bull or a bear, your primary problem becomes risk. Margin, collateral, liquidity. That's what drives the violent overnight moves. Not sentiment, not a tweet. Risk mechanics. Here's the clean way to think about that 5% overnight jump. And yes, not a random pop. It inks the market repricing the cost of being short at the exact moment liquidity thinned and hedgers had to act. Silver trades around the clock, but it doesn't trade with the same depth around the clock. There are hours where it is a thick river and hours where it is a narrow canal. In the canal, it only takes a few aggressive orders, a few stops, and a few dealers adjusting hedges for the tape to jump. And silver's personality is that it doesn't politely walk through levels, it snaps, it jumps, it tests your stomach. Because if this one level breaks, the math changes. Now we get to the conflict, the force trying to suppress or deny or ignore the move. It's not a shadowy villain in a cape, it's the institutional instinct to frame everything as just speculation. The mainstream loves the story where metals spike because retail got excited and then it fades. That story protects the status quo. It suggests nothing structural is happening. It suggests you can ignore physical tightness, ignore term structure, ignore delivery mechanics, and just wait for the excitement to cool. But when the paper market is forced to chase physical, that narrative gets dangerous, because now you're not talking about a mood swing. You're talking about a supply and collateral problem, and the hidden detail that makes this entire move make sense is buried inside one boring word: deliverable. On COMEX, people love to quote total inventory like it's the fuel gauge for the whole market. Plenty of silver in the warehouses, they say. So what's the problem? Oh, the problem is that not all warehouse inventory is the same kind of inventory. They're S metal that is registered, meaning it S available to be delivered against a futures contract, and metal that is eligible, meaning it meets specifications and is stored there but is not committed to delivery. Eligible is in the building. Registered is on the menu. And in a stress window, the menu matters more than the building. Because if you want delivery, you can't eat the chairs. You can't deliver the concept of metal. You need registered supply, or you need to convince holders of eligible metal to convert it. And that conversion is not automatic. It's a choice. It's a negotiation. It's a function of incentives. So when you see a physical market printing crazy all-in prices and a futures market gapping higher, you're watching incentives shift in real time. The paper market is realizing that deliverable supply is tighter, more reluctant, or more expensive than the calm period assumptions. And that is the moment the whole setup flips, because once participants believe deliverable tightness is real, the behavior changes. Shorts get less confident, longs get more stubborn, spreads start talking. And when spreads talk in metals, you should listen. But wait, before we go to spreads, we have to talk about the calendar, because this is not just right now, it's right now in a specific window. Futures markets have rhythm, delivery months have rhythm, notice periods, first notice day, last trade day, rolls, options expiries. These dates are not trivia, they are catalysts, because big players don't move when you want them to. They move when the calendar forces them. And silver, especially during a high volatility run, becomes a game of musical chairs at month end. Funds need to roll positions, commercials need to hedge shipments, dealers need to manage options exposure, and banks need to manage balance sheet usage as reporting periods approach. That's your why now. If you were seeing abrupt repricing and the market feels like it's being shoved rather than led, it's usually because someone doesn't have the luxury of waiting. Their mandate says act. Their risk model says act. Their collateral call says act. And in metals, when participants act under time pressure, price discovery turns savage. That's why a 5% overnight jump is not mysterious. It's familiar. It's the sound of forced repositioning and thin liquidity. And the next detail is what flips the whole setup: margin. If silver is pushing into triple digits and volatility is spiking, exchanges and clearinghouses start paying attention because their job is to ensure the system survives the worst day. So margin requirements change, sometimes abruptly, sometimes mechanically. Recently, the conversation has been about moving margins to a percentage-based framework rather than fixed dollar amounts for precious metals, which sounds like a technical footnote until you understand what it does to behavior. A percentage-based margin system scales collateral demands automatically as price rises. That means when silver rises, the cost to hold a leveraged position rises with it, even if the contract size is the same. That squeezes the weak hands. It forces funds to reduce exposure. It forces some shorts to cover not because they think they're wrong, but because they can't justify the collateral. It also forces some longs to sell into strength just to keep the position alive. And that's why silver can rip, dump, and rip again while the thesis stays intact. The thesis can be tightness and macro demand, while the tape is margin and liquidity. Don't confuse them. That distinction, trend signal versus noise, is the difference between getting shaken out and staying rational. Now, let's talk about spreads, because if there's one place the truth leaks out, it's not the headline price, it's the structure around it. In a normal contango market, later months trade higher than front months because storage and financing cost money. In a stressed market, you can see backwardation, front months trading richer than later months, because the market is effectively paying a premium for immediacy. It's the difference between metal eventually and metal now. And now is expensive when deliverable supply is tight or when people are worried it might become tight. Even without quoting exact spread levels, you can watch the behavior. Do nearby contracts stay bid? Do roll yields change? Do EFP dynamics and off-exchange settlement chatter heat up? Do leasing and borrowing costs become a storyline? Those are the tells. When the curve tightens and the front end gets aggressive, that's the market screaming about urgency. And that urgency is exactly what makes physical hubs like Dubai look crazy. Because physical hubs are the place where now is the whole product. You can't deliver later to someone who wants it in hand. So physical premiums become the canary. And paper has to eventually respect the canary if the dislocation gets large enough that it threatens the delivery ecosystem. But here is the twist. The arbitrage that should fix it is not as clean as people pretend. Yes, in theory, you buy futures, stand for delivery, take the metal, ship it to where premiums are high, and pocket the difference. In practice, that trade has landmines. First, not every form of silver is interchangeable. Bars have specs, brands matter, assay and acceptance matter. Second, timing is everything. If you're early, you're financing a pile of metal for longer than planned. If you're late, the premium window closes. Third, logistics are not free. Insurance is not free. Compliance is not free. And in a stressed macro environment, the cost of capital and the availability of financing can change faster than your spreadsheets. Fourth, there's counterparty risk and operational friction. And fifth, and this is the quiet killer, some of the entities that could do the RB at scale are the same entities who are managing systemic risk. and they don't always press the trade if it makes their own balance sheet more fragile. So dislocations can persist longer than efficient market people want to admit. And during that persistence, paper gets dragged toward physical, not the other way around. That's why the screen had to jump. It wasn't enthusiasm. It was an adjustment toward where metal clears when constraints bite. Now layer in the macro regime, because silver doesn't exist in a vacuum. When markets get nervous about policy, geopolitics, or currency stress, hard collateral gets bid. Gold usually leads because it's the cleanest monetary metal, but silver is the high beta cousin. When flows come in, silver can overshoot because its market is smaller and its liquidity is thinner. You don't need to pick one macro headline to explain it. You just need to recognize the pattern. When uncertainty rises and real rates and inflation expectations and currency narratives get messy, the bid for tangible assets intensifies. And that macro bid doesn't care about whether silver is overbought on a momentum oscillator. It cares about allocation and hedging. That's why at the same time you see physical premiums and delivery chatter, you also see broad commodity index behavior matter. Here, as a piece most retail investors ignore until it smacks them. Index rebalancing and systematic flow can create big price moves that look emotional, but are actually dumb mechanical buying and selling. Commodity indices roll futures. They rebalance weightings. They follow rules. They don't argue with your chart. If a big index needs to roll out of a front month into a later month, that's a predictable wave of selling and buying across the curve. In a quiet market, it's absorbed. In a stressed market, it becomes a shove. And when the tape is already jumpy, that shove can trigger stops, trigger hedging, and trigger a feedback loop. And then the retail crowd sees the candle and says, "This is manipulation." No, sometimes it's just the plumbing. The plumbing is brutal, and it doesn't care about your feelings. Now, because you're finance-minded and skeptical, let's build the proof stack without leaning on one fragile argument. Proof point 1. The price action itself, an overnight 5% gap in a contract that S already been running, is a signature of liquidity stress and forced hedging, not a gentle narrative repricing. Proof point 2, the month-to-date move, the sprint from the low 70s toward the 100-plus zone, tells you volatility regime has shifted, which increases the probability of margin and collateral events. Proof point 3, the physical signal, Dubai or similar hubs showing high all-in pricing, tells you premiums and immediacy are expensive, which usually correlates with tightness, or at least perception of tightness. Proof point 4, the market structure signal. Watch the curve and the roll behavior. And when front months stay sticky bid and the curve compresses, that's urgency being priced. Proof point 5, the inventory mechanism, deliverable versus non-deliverable categories, explains why plenty of metal in warehouses can coexist with stress. Proof point 6, institutional flow behavior. Index rolls and systematic exposure shifts can amplify any existing stress exactly during calendar windows. Proof point 7, the sneaky one, psychology and positioning. Because in a market that's ripping, shorts don't just hold their view. They pay a rising collateral bill every day. Their risk managers call, their margins change, their VAR models scream. And at some point, the trade stops being about being right and becomes about staying solvent. Forced covering is not a theory, it's a mechanical behavior. When enough shorts cover into a thin tape, price jumps, which forces more covering, which forces dealers to adjust hedges, which jumps price again. That's reflexivity. That's why silver moves in slabs, not in lines. And that's why the headline, COMEX jumped 5% overnight, is not the story, it's the symptom. But here's the counterpoint that keeps us honest, because if you want trust, you can't pretend every bullish signal is destiny. Physical premiums can be localized. Retail pricing can reflect fabrication and availability in certain products, not necessarily the wholesale bar market. A number like Dubai at 96 can be a blend of unit conversions, product premiums, and timing snapshots. It can be real and still not map cleanly to the global benchmark at every moment. The curve can normalize quickly if liquidity returns or if carry incentives change. Inventories can look tight in one category and loosen through reclassification or incentive shifts. And margin mechanics can cause violent sell-offs even inside an uptrend, especially because when a position becomes expensive to hold, both longs and shorts can be forced to cut. So the right stance is not guaranteed moonshot. The right stance is high volatility regime with structural stress signals, which means you respect both upside continuation and downside whipsaw. Because this is where volatility will be used against you. That's not a conspiracy line, it's a behavioral reality. In a fast market, the easiest way to transfer wealth is to shake out weak conviction. Price will spike, pull back hard, print scary candles, and flood your feed with smug takes. The emotional manipulation is predictable. When it rips, you'll feel FOMO and chase. When it dumps, you'll feel panic and sell. Then it rips again and you'll feel stupid. Then you'll chase again. That's the loop. Your job is to step out of it. Your job is to separate trend signal from noise. Trend signal is what spreads, calendar pressure, and deliverable tightness suggest. Noise is the intraday violence caused by margin, liquidity gaps, and stop runs. You don't beat this market by being the loudest. You beat it by being the most prepared. And that preparation looks boring. You define levels, you define invalidation, you define what confirms, and you define what you will ignore. Because the market will try to make you make a decision at the worst possible time. But that's not the part that matters. What matters is what comes next, right now, this week. Because the setup gives you a near-term roadmap if you stop staring at the headline. Here's the simple two-scenario lens that keeps you sane. Scenario 1 is the controlled pullback and retest. In this scenario, the overnight gap and the spike into the triple-digit zone attracts profit-taking and margin-driven de-risking. Price pulls back toward the pre-gap area, tests the zone where the breakout started, and either holds or fails. What confirms scenario 1 is healthy is not it never goes down. Healthy is it goes down and refuses to break key structure. You want to see dips get bought without spreads collapsing into complacency. You want to see physical premiums stay elevated relative to calm periods. You want to see the curve stay tight enough to imply urgency, even if the headline price cools. The key levels in this framework are simple and universal. The gap low, the gap midpoint, and the prior swing high that got cleared. If price holds above the gap low on a closing basis and reclaims the midpoint after a pullback, that's strength. If it slices back through the prior swing high and can't reclaim it, that's the market telling you the move may have been more squeeze than structure, for now. Scenario 2 is the continuation squeeze with gap risk. In this scenario, the pullbacks are shallow, liquidity stays thin, and any attempt to fade gets punished because shorts are still trapped and dealers are still hedging. Price holds above the breakout zone, consolidates briefly, and then lifts again on the next catalyst. Maybe a calendar pinch, maybe a policy headline, maybe another wave of systematic flows. What confirms scenario 2 is not a single green candle. It's behavior, failed breakdowns, rising floors, persistent bid in the front end, and no meaningful relief in the signals that matter. In squeeze scenario, you get air pockets, you get gaps, you get how is this legal candles. That is the price you pay for being in a market where positioning is crowded and liquidity is finite. And if you're watching it from the outside, this is where you resist the urge to turn it into a religion. You don't need certainty. You need a checklist. And here's the checklist for the next week or two that actually connects to mechanism, not vibes. 1, watch how the market behaves around the gap zone. Does it treat that gap as a new floor or as a trapdoor? 2, watch the curve. Does the front end stay bid relative to the back, or does it relax quickly? 3, watch for margin and collateral chatter. Any tightening of requirements increases the odds of violent flushes and equally violent rebounds. 4, watch physical signals, premiums, availability, delivery times. You don't need perfect numbers. You need direction. Are they easing meaningfully or staying sticky? 5, watch the calendar. Roll windows, delivery interest, options expiries. These are the moments when forced behavior shows up. 6, watch the dollar and rates narrative, not as a prophecy, but as a flow driver. When macro uncertainty surges, silver's beta can reassert itself fast. And 7, watch the psychological battlefield. If your feed suddenly becomes uniformly confident, either bullish euphoria or bearish mockery, that's usually late. The market loves maximum pain. It loves to punish the largest number of people at once. The way you defend yourself is by pre-deciding what invalidates your thesis. Not, it went down. That's noise. Invalidation is structural. Spreads normalizing aggressively while physical premiums collapse. Repeated failures to hold reclaimed breakout zones. A shift in curve behavior that suggests urgency is gone. Or a clean break below the area that made the squeeze possible in the first place. And yes, price can whip around violently even if the thesis is correct. That's not a disclaimer. That's a feature of this market. Silver is the kind of asset that makes correct people look wrong for longer than they expected. It makes patient people look foolish before it makes them look smart. It makes impulsive people donate money to the spread. So if you're going to be in this conversation at all, you need the viewer psychology shield. You need to recognize the 3 emotional traps. Trap 1, anchoring. You anchor to where silver should be because of last year's prices, and you dismiss new information. In a regime shift, anchoring is expensive. Trap 2, recency. You believe the last candle predicts the next candle. In a high-vol regime, the last candle is mostly about liquidity, not destiny. Trap 3, identity. You become a silver bull or a silver bear instead of being a risk manager with a thesis. The market punishes identity. It rewards adaptability. So here is the simple mental model that keeps you out of trouble. Treat the headline move as a symptom of stress between paper and physical. Treat the calendar as the trigger that forces behavior. treat deliverable supply as the hidden constraint that the crowd ignores, and treat volatility as the weapon that will be used to pry you out of your plan. And if you want one metric to keep taped to your screen mentally, it is not the meme number from Dubai, and it is not even the last traded price. It's whether the market continues to pay up for immediacy, whether the system is still pricing now as scarce. Because if now stays expensive, the paper market has a problem. If now becomes cheap again, then the pressure valve opened and the move can breathe, or reverse. That's the signal. And that's why this isn't just a story about a 5% overnight jump. It's a story about who is being forced to do what. Dealers forced to hedge, shorts forced to cover, funds forced to roll, clearinghouses forcing more collateral, physical buyers forcing premiums. And at some point, the only way to clear all that force is a higher price, a violent reset, or both. So here is the payoff I promised: how to act like a grown-up in a market that wants you to act like a teenager. Pick your time horizon. If your horizon is days, respect the gap zone and the volatility. If your horizon is weeks, respect the structure, the reclaimed breakout area, the behavior of dips, and the persistence of urgency signals. If your horizon is months, focus on the macro and the supply chain reality. Mining and refining, Don T. Ramp on command. Industrial demand doesn't negotiate with your chart, and when capital decides it wants hard collateral exposure, silver's small market can amplify the move. But no matter your horizon, do not confuse excitement with edge. Your edge is having a plan when everyone else has a feeling. Your edge is knowing exactly what would change your mind. Your edge is not needing the market to validate you every hour. And if you are just really the kind of person who watches metals because you don't fully trust institutions, here is a healthier version of that skepticism. Dunty waste energy on certainty about villains. Focus on incentives. Focus on constraints. Focus on market structure. That's where truth lives. And if you want to be part of a community that doesn't get farmed by volatility, the only CTA that matters is this: stay in the camp that watches the plumbing, not the pundits. Watch the curve. Watch deliverable tightness. Watch the calendar. Watch the gap behavior. Share your observations, challenge weak arguments, and keep your ego out of the trade. Because the next week or two is exactly the kind of tape that will reward calm, prepared minds and punish emotional improvisation. And if this one level breaks, the math changes. So let the market show you which scenario you re in before you start acting like you already know the ending.